Welcome to Real Estate Investing for Professional Men and Women, the podcast that guides professionals to financial prosperity. Join our community and let's start building your wealth. Here's your host, Gary Wilson.
Hello, everyone. This is Gary Wilson, and welcome to this week's Real Estate Investing for Professional Men and Women, the podcast for you. Typically, you're a pilot, engineer, business owner, CEO, whatever, dentist, orthodontist. We do invest in real estate, and we do invest ethically and honorably in the areas we do invest in. So it's win-win for everybody. We buy not A-plus luxury, but decent properties, and or we look for value and improve the area. So the area wins, the tenants win, we win, on down the line. So if you haven't yet subscribed to the podcast and you like this, please feel free to do so. It's on several dozen channels, iTunes, iHeartRadio, Stitcher, and now downloaded in, I think, 30 different countries. So also, if you want to be a part of the community, absolutely go to myinvestmentservices.com. Go into the click on members area, click on server level, and you can participate. You can just dabble your toes if you want, but jump right in, because there's thousands of us across the U.S. and Canada. All of us we are tied to real estate, but we also have other businesses and things like that. And it's just the way we do things in network. And by the way, the big plus is we've got several thousand what we call investor agents. These are agents we've trained specifically to work with us. They're certified investor agents. So make sure when you're working out there with an investor or agent, make sure they demonstrate that they're a certified investor agent. We know who they are because we trained them. So without further ado, great subject today. We got Bruce Petersen on board here for you to enjoy and entertain and learn from. So first off, Bruce, thanks for taking your time and joining us. I know you're a busy guy, and I appreciate you sharing your time and wisdom with us.
Of course, man. Glad to be here.
Awesome. Hey, if you wouldn't mind, just kind of paint a picture for us. Some people may know who you are, certainly where you are, but for those who don't, give them an idea of who you are, how you got to where you are, what it was like in the beginning, and show them that path so that they can see themselves doing it too.
All right. Yeah, cool. So I'm a syndicator of large apartment complexes based in Austin, Texas. Our portfolio right now is between Austin and San Antonio. We've syndicated 1,100 units to date. Been doing it for about 7 or 8 years. Getting close to 8 years now. National award winners at what we do. Enjoy it. We have a management company. I say we. It's my wife and I. We're equal partners in the business. But anyway, so we syndicate. We have our own management company. So we do all of our own management, construction company. We try to be vertically integrated so I can control quality all the way through. That's our big thing. So where did I come from? How did I get here, right? Grew up pretty poor, very common story. Grew up pretty poor, sucked in school, barely got out of high school. But in 1986, just the thing you're supposed to do, you're just dogmatically going to go to college.
Mm-hmm.
I barely got out of high school. Now I'm going to go to college. Well, because I was supposed to. I was terrible at it. I'm smart and I'm a lifelong learner, to use a cheesy term. But school did not work for me at all. So I dropped out of college. I was going to school to get a finance degree. My idea was I was going to be a stockbroker. Mm-hmm. Well, I entered a want ad for a stockbroker. I thought I'll never get it. I don't have the degree yet, but at least I'll get some practice in interviewing when I do have my degree in hand. I somehow thought I was going to get a degree, but I entered this first ad and I went in for the interview and I got the damn job. I'm like, oh, okay, I don't know what just happened, how this happened, but I got the job. They sponsored me to get all my certifications with the SEC. So Series 7 and 63 licensed. Did that for a little while until the market fell apart in 91. We went to war, Desert Storm, market seized up from my end of it. I'm 23 years old. I'm not saving my money. So I'm going hungry now. So then I took a job at a bank making, $5 an hour, 20 hours a week as a drive-through teller. So you go from 6 figures to that. That's painful. That's really painful. Don't have a degree, so I don't have a whole lot of options right now. A friend offered me a job in retail. I thought, well, I got to do something. This is not working. So I got kind of trapped into retail for 18 years. I ran big box stores, Bed Bath & Beyond, Home Depot, Lowe's, Best Buy, that kind of thing. I did that for 18 years, hit a wall at 43 years old and just walked away. I'm 5'8", so I'm not real tall. I was 240 pounds. no wife, no kids, no dog, nothing. Right. So I'm seriously depressed. I hate my life. I was working 100-hour weeks when I quit. I just drove around the country for about a month and a half trying to decompress and clear my head. Came back, realized I need to figure out what I want to do now that I'm a grown up and I have the rest of my life to figure out. I found a mentor that taught me how to buy and manage and run apartment complexes. Bought my first deal in 2012, 48 units. And again, we've done a total of 1,100 units now, spanning 6 different assets. So that's kind of where I am now.
Awesome. Hey, so now I know you're living in Austin now. Where was the 48 unit?
It was in North Austin.
Okay. And that was 2012. So you've seen some tremendous growth in that area in the last 7 years. I mean, I just was there, not last week, the week before, actually, teaching, or maybe 2 weeks before, but great area. I was at a little place called New Braunfels. I'm sure you heard of it, Schlitterbahn, famous water park, And then stayed another week at Lake Travis, beautiful area, and been a tremendous opportunity there for investors for quite a while now. It's just, the pricing's definitely moving, keeps going up. But the thing is, when you're doing apartment syndication, you're not really looking at the residential or owner-occupied world so much. And I love nice homes on the lake, no doubt about it. But the fact is way more wealth was made in owning apartment buildings. At least for me and probably millions of other people too. But if you wouldn't mind, tell us a little bit about that deal, that 48 unit, how you found it, how you bought it, how you structured the deal. Was it just you? Was it you and 5 other people? What was the legal structure? Things like that. Because I want people to see that, anybody can do this. I've done it too. And I wasn't born that way. Matter of fact, you and I have very similar backgrounds. So if you wouldn't mind, kind of paint that picture of that first deal, and then we can go deeper from there into different projects,
Okay, so the 48 unit bought in 2012, paid $34,000 a door roughly. It's for sale by the guy that bought it from me right now for, I believe it's $85,000 a door. So I paid $1.6 million for the deal. I had to come into the deal with $575,000. I've syndicated everything I've ever done. So even that first deal, I brought in 14 other investors with me. I had started my own meetup here in Austin, and over about a 6 to 9 month period, it started to grow, and we got to know each other very, very well. I had no experience, no track record, but we got to know each other on a very personal, almost an intimate level. So they trusted me that I would do everything I needed to do to make it work. So we formed an LLC, completely got set up the right way legally to make sure everybody's protected. Everybody knows exactly what's going on, the way it's going to be managed. So did everything right. Like I said, I brought in $115,000 of my own money, and I raised the other $460,000. The plan was to hold it for 5 to 7 years. And so I started looking around in 2015. We had owned it for a little over 2 years. And I thought, okay, the market has appreciated dramatically. We've run a good property, but the market has really taken off. So 2012, 13, 14, it had really rocked. So I looked around and thought, it might keep going, but it might not. Right. I can lock in a huge return right now and not get greedy. So I put it out to the investors, and everybody but one said, yeah, we agree. Let's go ahead and sell it now. It's sooner than we thought, but it's probably prudent. One guy did ask, so Bruce, we bought for cash flow, right? So we always buy for cash flow, and we're happy with the appreciation we might get. But he said, we're buying for cash flow. Why are you selling our cash flow? I was like, dude, look, I can sell and get you 8.5 years worth of cash flow in one transaction, one day. And again, I don't want to be greedy. If the market turns on us, now it didn't turn back in 2015. We had more room to run, but I was fine. We got a 300% return on that property, and we were very, very happy. So that first property turned into 2 additional investments for me personally, because the proceeds from that one funded the purchase of the other 2 as far as my portion of that purchase is concerned. So we did great with that one. Again, I had a mentor to kind of, answer some questions along the way, but I'm the one that had to get in there and do it. And it worked out really well.
Yeah. So now as far as the structure goes, were you looking for, we used to call them accredited investors. And, in the old days, you had to have a net worth of $1 million, annual income $250,000, and then I think in the Obama years they changed some of that. I'm not really quite sure, but how do you how were you selecting, or what was your criteria for someone to be part of the syndication to invest with you?
So we filed what's called a 506B registration with the SEC. So we were exempt from full registration. With the 506B, I can have accredited and non-accredited. I'm only allowed to have 35 non-accredited, but I have to ensure that they're sophisticated. They understand what it is they're getting into. They understand the risk profile involved, and we get to know each other at a very personal level. So we brought in, again, it was 14 investors plus myself. But again, it was just all people that I met going to different real estate conferences and real estate networking events around town. And I just pulled this group together. Investment level, I had 2 people in at 10,000, had one guy as much as 100,000. It was very important for me to have the most in the first deal with no track record. So that's why I decided to go in at 115. So, I had let's see if I can remember this. I had a math teacher, a high school math teacher in it. I had a private investigator in it. So, man, look, a lot of people think, oh, that's what billionaires do. They buy apartment. I'm not a billionaire. I'm a college dropout, and I got math teachers in my deal. So, man, this is available to anybody. You just got to find the right deal with the person that you know, like, and trust.
What's interesting is I teach, every day I'm either teaching investors or teaching agents how to work with investors. And soon, whenever I say teacher, everybody's like, well, they can't invest. They don't have any money. And I'm like, for some reason, they're one of the top 7 groups of investors. And it turns out there's a really awesome book, goes back about 25 years, called The Millionaire Next Door. You've probably heard of it. Famous book. And in there, they rank by category millionaires. Guess what the 3rd rank was? It was teachers. So we have all these limiting beliefs that, well, you got to be rich to do this stuff. And you got to be an accountant or attorney or a lawyer or a doctor. And I'm like, not really, that's not what they are. Matter of fact, those 3 I just mentioned, doctors, lawyers, and accountants, were not even in the top 10. Right. It's people like one guy I read, he was a junkyard owner. It just never ceases to amaze me. The people they're doing this. It's basically because you have that drive, the ambition to not be poor anymore, to not be broke anymore. It's like you just get tired of being tired and broke. So it just drives you forward. So let's talk a little bit about where. So obviously, I know you're in Austin. That was in Austin. Have you branched out in other parts of Texas or other states, or what's your take on like Ohio versus California? One's obviously low price, one's very high priced, and what's your take on like where people are, geography?
All right. So, everything we own right now is in Austin and San Antonio. We are starting to branch out. We started our look. We haven't bought anything yet, but notable states that you mentioned. I don't want any part of California, and I think everybody understands why. Prices are too high. Returns are too low. I'm banking on appreciation. To me, that's a risky, almost a fool's game. If the market turns and your whole investment thesis was tied to the price of the property going up in value, there's a good chance you're going to lose. So I don't like any of that. I don't like the business environment in California. And then Ohio, it's not a bad state necessarily, but it's out of what I want to do, right? We're trying to stay out of really cold areas, right? So I don't want to deal with snow removal and all that stuff. Yes, it'll work. People are doing it now. We just don't want to deal with it. We're looking for landlord-friendly states and dynamic markets with a net growth in population, wages, job creation. Like I said, landlord friendly is a big part of it too. So we're looking throughout the Southeast. We just opened our 2nd management company in Nashville, Tennessee. So that's kind of a base of operations now. So now we can get quickly to a lot of the hot Southeast markets and start trying to purchase there. So again, that's kind of my criteria, and that's kind of where we're headed next.
I love it. Everything you just described there spells Texas. I mean, I'm here now. I'm here in Texas.
It does.
Yeah. I tell you, it's a huge state geographically. You got some major metro areas growing like crazy. Dallas is just insane.
Yeah.
I'm here in Houston. It's like, every road is being widened. And of course, where you are in Austin, San Antonio is probably my most favorite part of the state. But you've got, Laredo all the way down near Brownsville, Harlingen, McAllen. They're not the big areas. They're smaller areas, but they're growing like crazy. I mean, it's just it's a very owner friendly state, investor owner friendly state. I mean, California, we've all heard. This is going to date this podcast, but the governor, and I don't really watch TV. I don't even own a television, but apparently just signed an executive order to make the entire state rent control, California. I'm like, boom, they just put the squash on that one, Now, I'm not saying you can't invest there. You can go to the Central Valley, Bakersfield, Fresno, Modesto, and still invest there and be within the limits of whatever the rent controls are. But if you're in San Francisco, now you're really stuck with an appreciation game. And it's been that way for years anyways. People would buy there with negative cash flow because they knew it was going to appreciate and double in 5 years. But for me, I'm really conservative. I've done that stuff before, and it does work. But to me, I'm more of I'd rather get a lot of small little paychecks every single month for a long period of time. It's just
right.
me.
And so that approach, which is my approach, is, I'm not going to hit a lot of home runs that way, but it's safe, it's conservative. And, if the market changes, right, again, I need to make sure that I can absorb whatever downturn comes. So, everything we buy is going to be a 6 to 8% return by the end of the first year is our target. That's what we're looking for. So I can ride out a downturn in a market. Yeah. Right. The whole thing with California, prices are sky high.
Mm-hmm.
You're going to be taxed 13% on your earnings. So that's rough. And I've heard stories by talking to friends about, 2 states in particular that come to mind are New York and California. Yep. They can take over a year to evict somebody for non-payment of rent. The hell is that? Exactly. I can get them out in about 2 to 3 weeks in Texas because, they realize we're running a business and nobody gets to live for free. So, that's a huge part of why we're in Texas and trying to go throughout the Southeast. They're more than
absolutely. Yeah, Florida, same thing. See, Florida is so heavily influenced by the hotel motel industry that their landlord tenant law is heavily influenced by the hotel motel industry. So it's easy there too. It's easy there to operate. Yep. I mean, Tennessee, like you said, the great thing about Nashville, it's been also one of the hottest growth areas for a generation now. It's a fun place. I love it. I was just there last summer. I was there 2 years ago too. But you can, within a couple hours, get to Memphis, a couple hours get to Chattanooga, and they're both are great. And Memphis is a lower priced area, but it's a great area to invest in. Chattanooga has been growing like crazy. People are now living in Chattanooga, driving to Atlanta to work every day. Like, holy mackerel, So, and there's a lot of great areas in South Carolina around Columbia, University of South Carolina's down there. Upstate, you've got Clemson, and, it's just, North Carolina is the same way. But oddly enough, though, Virginia, believe it or not, is actually more tenant friendly than even Pennsylvania. So Pennsylvania is like 2 states, Philadelphia, pro-tenant, Pittsburgh, pro-owner. But the state law in Pennsylvania is more owner-friendly than the state law in Virginia. Go figure.
Yeah.
So I appreciate that insight, and it just goes to show you that there's always opportunity. You study, you get the data, guys. Always get the data. Let data drive your decisions and actions. And in Texas is centrally located, you can fly there. You can fly to Dallas from a number of areas. And with no connections. In Austin too, for that matter. And then fly to Dallas and then drive to Houston, drive to Austin, drive to San Antonio, and do yourself a favor and invest there. So now as far as timing goes, you mentioned 2012 was when you got that first one. Of course, that was, we'd been in the recession for 3 or 4 years. It was still at the bottom, but looking at turning up, and then it started turning up like late 2011, depending on where you were in the country. But what have you seen timing-wise from 2012 to now? If you could paint a timeline and what you noticed, because people always say, well, I'll wait till the market this, I'll wait till the market does that. My experience has been, we're always investing. We never stop investing,
Right. So, and I agree with that completely. Buy now, don't wait, because you're never going to act. It's the mindset that there will be another reason not to buy. Right. Well, okay, so the economy, but let me wait for this to happen. Let me get married. Let me get my kids out of college. There's always going to be an excuse for those people, and that's fine. You don't want to do this, apparently. And I have no problem with that either. There's more for me to buy, right? But, even in a hot market like this, I could still find deals. They're harder to find, no question. And I got to be more conservative in my underwriting. I got to make sure that these deals, again, will withstand a downturn of 10 to 20% drop in rents, because it can, and it has happened, right? Mm-hmm. So, it's something I heard Grant Cardone say, and I agree with it completely. Start now, because when the market corrects, if you wait for the market to correct to get started, well, you can't capitalize on that market that corrected. If you start now, buying safely, again, don't be reckless, but buy safely, cut your teeth now, learn the process now, build your database of investors now. So if and when that correction comes, you're ready to capitalize. And instead of buying a 12 unit, you might be able to buy 100 units or 200 or 300 units. You will kill it in a downturn. That's where you're going to make the majority of your money. So get started now. Do not wait.
Yeah, I agree 100%. I mean, what's funny is a lot of people were around now in the last recession. And granted, the last recession was long and deep. But what people don't recognize, if you study the history of economics and study the business cycles over the last 100 years, most downturns are triggered by other factors. And real estate is simply a factor in the downturn, but it's not usually the main factor. So it just kind of everything goes down, so real estate goes up, but very mildly. Real estate is usually a very slow moving commodity compared to other businesses, other industries. Like the stock market, it's fast, but in the real estate, it's slow. The other thing is this: the last recession was led by real estate. Absolutely, but it's very unique, and it was because everything started back in the 70s. If you track the history of what happened with the advent of selling mortgages, that all started in the 70s, and then in the 90s they lowered lending standards because the Clinton administration, they wanted to have a higher percentage of ownership. Noble cause, no doubt about it. But what it did is it created this other ancillary industry, the mortgage brokerage business. And then in the 2000s, when they were running out of people to buy homes because there was just everybody bought a home, they started really lowering their standards, and even a lot of fraudulent stuff. Unfortunately, it's all documented now. That's all very. I'm not saying it can't happen again. And in every recession, things go up and down, including real estate. But real estate is usually the safe haven. So the other part of this is too, like you said, think about when you invest in mutual funds. You dollar cost average, and when prices are high, you're buying fewer shares. When prices are low, you're buying more shares. Over time, you're ahead of the game. In real estate, you should always be in the game, not just for that reason, but also more importantly, you want to learn when it's the easier time to learn. Like you said, Grant Cardone said it, do it now. The economy is going to go down. Just get used to it. It's going to go down. It's going to go back up again. But wherever it is, just start. Just get started so you can learn the business. And then when Christmas time comes and everything's down, you're prepared to pounce and build up your portfolio more aggressively. So, I hope I just emphasized what you said enough for people to grasp it. The timing, the people that say, "I'll just wait." All you're doing is saying no. You're just saying no to profit and wealth.
Right.
So, in any case, I'll get off my soapbox here. I feel like I had my preaching moment.
All right.
But let's talk about a little bit more about the how. So once you acquire a property, you mentioned you have property management. Is there a certain strategy you follow? Like, in other words, improving the quality of the units so you can attract better tenants and raise the rents, or I know the REITs do a lot of that kind of stuff, but is there a particular strategy you found that really works well for you to more aggressively increase the value in these properties, or just basically cash flow from them more?
Right. So our approach right now, we're buying cash flowing assets. We're not finding a bunch of deep value add property that we can come in and completely reposition, turn the whole thing around, run at a loss for 6 to 18 months while we reposition, and then have this massive windfall in the back end. Not finding a lot of that right now, but I'm still able to drive value because of our operations. So the low hanging fruit, the thing that everybody knows, go in and upgrade a unit for $3,000 to $5,000, get another $50 to $100 a month in rent. Well, first of all, you better be sure that that's going to happen, right? So do your market surveys, do very detailed market surveys, make sure that thesis will work. And even when you do that, that's still academic. You don't know it'll work until you get in there and actually try it, right? So there's that thing. Everybody knows that. But what we do, the biggest thing we do on top of that, is we institute a lot of revenue streams that a lot of other owners just never thought about or had the courage to try. We're buying, institutional quality assets. We're buying 200 to 400 unit properties. We're buying them from institutional investors very often. They're good at capitalizing on a part of the economy right now, a niche industry that they saw I could buy pretty cheaply, do some rehab, put lipstick on the pig, turn around and sell it and make a profit. They don't really know how to operate that well. Some of them do, but a lot of them don't. So what we do is we come in behind them and we institute all kinds of revenue streams that they never thought of. We build carports, 50% ROI on a carport. If I put in a carport structures at one of my properties, and it made the property worth $600,000 to $700,000 more because I can spend $930 per unit to build it, for each space to build it. I can rent it out in Austin for $40 a month, right? That is huge. That's a 52 to 55% margin, but also, again, it made it worth hundreds of thousands of dollars more by looking around. What did the property not have? What did nobody else in the neighborhood have? Well, they didn't have parking structures, so we were the only ones. Well, now everybody in the neighborhood's built parking structures, and everybody jumped on that bandwagon. But we are the middleman to provide renters insurance for our people. Everybody has to have liability, I should say, liability insurance of $100,000 to move into our property. We can help you get that if you choose. You can bring your own if you want. We have started rolling out smart home items, door locks, thermostats, that kind of thing. So that's our biggest thing, is tightening up the ship from an expense standpoint. Are they overpaying for different things that they need on the property? Landscaping, courtesy patrol, that thing. But the biggest part of it is driving the revenue forward with other income items. Yeah.
We have one building we bought probably 11 years ago, and it was post World War II construction, so all bricks, Traco, updated Traco windows. We redid bridges to the door fronts, all this stuff, really neat looking things. But one of the biggest ones we ever had was, and you wouldn't think of it, there was these old boilers that were like 30, 35 years old, and they were operating at about 60, 65% efficiency. And we said, look, we need to replace these things. Of course, the cost of those replacing those big industrial boilers is quite expensive, but we did it. And you know that we made our money back in less than 2 years, because we went to 90% efficiency just on the old boilers providing the old radiant heat. We also spun off all the garages separately from the apartment leases. The old owner was giving the garages away with the apartment leases, and we said, no, we're going to spin them off separately, made double the money on the garages. We also took another thing we really love. Here's this, you might like this, Bruce, is you probably do it too. Going back about 10 years, we got rid of all the old laundry machines where you put the coins in and you stick the thing in like a slot machine thing. And centrally in the hallway up by the front of the office, we have it's like an ATM.
Right.
And you put in a credit card or cash, and you put credits on your laundry card. And the laundry card you put into the washer and dryer. So there's no box for people to bust off with a hammer or anything like that. It's just all cash. We get the cash. We call that our fun money. We'd get it every month, pull it out, stack of money literally like 2 feet high, and count it up. And it was just an amazing thing. And we've also created storage in basements, anything we can do. We're looking wherever we've got space. Let's use that space some way, shape, or form and convert it into a cash flow thing. We've even turned we used to have a no pet policy. We're like, no pets. Only to find out we had pets. We said, look, let's stop fighting it. Let's have a pet policy. It ended up, and we would attract the good pet owners, repel the bad ones, and made money while we're at it. It became a profit center,
Oh, absolutely.
So, yeah. So a lot of interesting things here. But I tell you what, I appreciate you sharing all this information. If you could, for people who are interested in investing in the Austin, San Antonio area, I mean, I would like them to reach out to you because I know you trust you, we're the same, mastermind group together and all that. If you could, how can people get a hold of you? Is there something you think, a book you've written, or a podcast website? How can people reach out to you that are interested in investing in the area there?
All right. So the biggest thing, just go to apartmentguy.com. It's apt-guy.com. Go to the website. You can look around at things that we're doing, things we've done, things that are coming. You can subscribe there if you would like to look at the deals that we're doing, maybe invest with us, totally up to you. I have a book that will come out probably in December or January. We're kind of finalizing that now. So I'm going to look at my phone because I can't remember these numbers. But if you want a free copy of the book, just text book release to 415-528-7403. When the book releases, I will get you a free copy of the book. No shipping, no handling, no cost for the book, nothing. I'll just give you one for free. So if you're interested, follow up with that too.
Awesome. I'd like to have that myself. Yeah, well, I appreciate that. Hey, any parting words of wisdom? There's some of the folks who are going to be listening are going to be, a dentist that's had his or her practice for, say, 3 years and are now at the point I can see where I've got to build some passive income. Anything you would suggest, if you can think back to where you were, like mindset, help them take that step, something like that,
Well, just look at what you're doing. Look around you. Just go back and remember the pain that you've suffered. 2008, 2009, the dot-com bubble, all that stuff. Everybody, the people that you're talking about, they've probably traditionally been heavily invested in the stock market, either through ETFs or mutual funds or direct stock ownership. That when the economy takes a dump, everything goes down with it. It's irrational. You've seen the value of your 401k or your IRA get cut in half sometimes. For the most part, that's not really going to happen in apartments. That, together with the fact that we have unbelievable tax advantages in owning rental real estate that you're not going to get. See, I was a stockbroker in the early 90s, right? So I get that. I can do pretty well in the stock market. I can average 10 to 15% a year. But there's going to be taxes involved. There's going to be churn. There's going to be commissions, fees. A lot of people have gone to commissionless transactions recently. But still, with me, I'm paying almost no taxes legally because we have highly, let's see, how do I say this? Highly depreciable assets that we own.
Right.
The depreciation expense is crazy. And the investors, they're not going to pay taxes on the profit of the properties usually, right? Now, you got to recapture it when you sell. But again, the tax advantages are just unbelievable. So you should really look at this as an alternative asset class. You should put some of your money into it. You might not feel comfortable putting it all. Totally fine. You need some exposure to real estate, though.
It's funny. A lot of people who are in real estate will say, well, it's not very liquid. You can't get your money out. I'm like, well, I don't think so. A banker would rather lend you money on a piece of real estate than any time during the day than as opposed to your stock portfolio.
Exactly. They're not going to lend to you to buy, Bank of America will not lend you money to buy Bank of America stock, but they'll lend you money to buy an apartment complex, right? And I get cash flow every month from this. It's like a dividend stock, if you will, with crazy tax advantages.
Yeah, exactly. So, hey, listen, I think I speak for a lot of people, Bruce, when I say thank you for sharing your precious time and your valuable knowledge with us. This has been one of my favorite podcasts, and look forward to catching up with you in the future. And for everybody listening, take Bruce up on his offer. Get the book when it comes out. Go to the website, check out, look at some of the examples of things he's done. I think are going to be pretty well impressed. So if you're busy, you got a practice to run, you just don't have the time, this is one way for you to participate in real estate investing and not have to go look at properties and things like that. So again, if you haven't joined up, go to myinvestorservices.com, click on the members area, look at the silver level, check it out first for free if you want to be part of the community. Absolutely do it. There's several thousand of us out there. We network, do joint ventures, things like that. And we also have all those investor agents who are trained to work with us. They're not typical agents. They're investor agents. That's out there too. And obviously, please subscribe to the podcast, Real Estate Investing for Professional Men and Women. And we will see you on the next podcast. In the meantime, take care and God bless you and your families. Hey, bye-bye.
Thanks for listening to this episode of Real Estate Investing for Professional Men and Women. Be sure to go to myinvestmentservices.com to join our community and start building wealth today.